I've never been late on my taxes before, but my business didn't survive the recession. Now I owe more than I can possibly pay. I was a corporation. Can the IRS take my personal assets, my bank account, my savings, my 401k? It sounds like this person's afraid of losing everything.
Yeah, this is a very interesting question. This question actually touches on a few different themes with the IRS. First of all, this taxpayer has mentioned that they have never been delinquent on taxes before. That implies that they think they might get some sort of beneficial treatment because they've been a good taxpayer in the past. While the IRS may be less aggressive at the start of of collecting the tax liability, it doesn't mean that the IRS is going to reduce the tax liability or reduce penalties or reduce interest or anything like that. So having a good taxpayer history helps a little bit, but it's not going to help in any substantial, meaningful way to the outcome of the case. The second issue this taxpayer has mentioned is that they have a corporate tax liability because their business hasn't survived the recession. There are two different types of corporate tax liabilities this taxpayer can have. The first type would be a corporate income tax liability. It's possible that this taxpayer's corporation made money and owes income taxes. Just like individuals owe income taxes, corporations can owe income taxes as well. If a corporation fails and ceases to exist and owes income taxes, the owner of that corporation is very unlikely not going to have to pay that tax back, meaning that the owner is not going to be personally responsible for an unpaid corporate income tax. That's kind of a remarkable result really unto itself. If this tax, however, is a payroll tax, then the owner of the corporation could be personally responsible to some extent for the payroll tax liability. Generally, corporate owners, people responsible in the corporation for the payment of the payroll taxes, the people who are responsible parties within the corporation, can become personally responsible for the trust fund portion of the tax. That means the money that was withheld from the employee's wages becomes the personal responsibility of the corporate owner if the corporation fails and ceases to pay that tax back. So that's what could be happening here. And if that happens, once the payroll tax the portion of the payroll tax gets assessed to the taxpayer personally, then the IRS can go after their personal assets, such as bank accounts, wages, sources of income, things like that. The IRS generally, however, in this question, doesn't like to pursue retirement assets first. They give the taxpayer time and effort to resolve the tax problem before they're actually going to try and pursue the savings that are held in a retirement account of some sort.
Now, I know most folks that are in business and have a corporation make the incorrect assumption that if the corporation's dissolved, the payroll tax liability doesn't go away.
Yeah, the payroll tax liability doesn't go away, and the reason why is because there's a large public policy out there, an aggressive public policy that says if an owner of a business withholds from their employees' wages payroll taxes, but then doesn't send that money over to the government, that person should be personally responsible for that tax liability because it was never the corporate owner's money in the first place. For example, if an employee makes $100, that employee doesn't get a $100 check for a paycheck, they get about $80 for a paycheck. That means the employer is withholding $20 in this example, and then they have to pay an additional $10 called the employer's matching contribution and send that $30 over to the IRS. Now, if that tax doesn't get sent over to the IRS and is not paid, the IRS at least wants to make sure that the money that was withheld from the employee's wages is paid by somebody or is at least responsible. Somebody's responsible for that tax.
Now, this is a case where the tax on the corporation, the regular, for want of a better phrase, the income tax on the corporation dissolves, that's not an issue. But this payroll tax issue for folks that do go out of business, and unfortunately in these economic times there's a lot of that, you are going to remain responsible for that withholding. Now, let's kind of talk about my retirement accounts. You said the IRS doesn't want to go after those, but I believe they will if that's a last resort.
Yeah, that's largely true. The Internal Revenue Manual are the rules that the IRS has to follow in collecting unpaid taxes against taxpayers. And the Internal Revenue Manual states that the IRS shouldn't go against retirement accounts unless the retirement accounts grew at the time the tax liability grew. The IRS doesn't want taxpayers to not pay their taxes and then stuff money into a retirement account and then say it's uncollectible. So That's one exception. Another exception is that if they believe the taxpayer is going to put the IRS collection ability in jeopardy, the taxpayer may leave for another country or something and go beyond the collection ability of the IRS. Or if the case is so aggravated, the IRS believes that levying a retirement account is reasonable. There are exceptions, and the IRS can go after retirement accounts, but it's not the primary source from which they'll levy. The primary sources from which the IRS will levy will be wages and bank accounts primarily.
So if a business owner, somebody responsible for paying bills, who decides who gets paid, is stashing thousands and thousands of dollars in a 401k and not making those payroll tax payments, they're going to be in a world of hurt.
They could be. What will happen is that when the company fails and the business owner becomes personally responsible for the trust fund portion of the tax, the IRS will assess the trust fund portion of the tax to the business owner, and then the IRS will investigate to see when his retirement account was funded, basically. And if it was funded during the time the payroll taxes accrued, then that retirement account is easier for the IRS to go ahead and levy and attach.